Yeah, definitely. In when we were at zero rates before the Fed started to tighten, just to simplify the argument so it's clear, let's say 2/3 of the United States took their debt and they termed it out for 30 years with a 2.5% mortgage.
Right.
So let's just simplify and pretend everybody did that, or 2/3 of the economy, the people who owned homes, say, or half to 2/3 did that. Well, now when you raise rate, and for 10 years, if I had savings, part of putting zero rates and then quantitative easing is forcing me to move into more risky assets to get any return. Because if I put my savings in, say, T-bills, I made nothing for 10 years. So now I'm fully termed out on my debt. And then the Fed raises rates by 550 basis points. Well, once it's there, did that impact my debt? No. In fact, I'm still sitting in my 2.5% mortgage for the next 28 and a half years. But now my savings makes 5%. In a way, they've improved my personal economic situation. Even though they've tightened, for the short term, I'm more wealthy. My home price hasn't gone down. In fact, it's gone up. Stocks have basically gone sideways to up, depending on your time zone. And now I can take my savings and make 5.5% on them, whereas for a decade I made zero. At the same time, they raise rates another 50 basis points. It's not changing my cost of my cost of capital as a person. So in that environment, it is squeezing the people who don't own, who don't have long-term locked up debt. It's squeezing the people who are living on monthly loans or very short-term rollover loans. And eventually higher rates will slow the economy because any new endeavors have to pay a lot more to finance it. Any, as you roll over your debts over time, that jump in cost. And so that happens over time. But that doesn't happen in the first year, typically, maybe. And because of long-term debts, it might be a number of years. And I think that dynamic, the mirror image of it will happen if they ease. Let's just say they ease from 5.5% to 4%. They ease 150 basis points. Everybody go out and spend. All they've done is reduce my savings income. My debt is still at 2.5%. So am I going to go refinance now? Probably not, unless I wanted to move anyway. But there becomes a lot of frictions in there as a result, because you have people who bought a starter home, and now in the last few years, they've had an extra kid or two, and now their starter home became a forever home, and it's kind of tight. Or, so they've wanted to move, but it's hard to move with the higher interest costs. And at the same time, you have to refinance to get the equity out of your house that you have. And that's expensive too. And some people simply can't qualify. Other people who can qualify, they move around for so many reasons. I think I traded mortgages for a number of years, and it used to be that the average homeowner would sit in a home for around 7 to 10 years. And I'm guessing that's probably still the same, but with COVID, because nobody moved for a few years, it might be a little bit extended at this point. But you have that dynamic that I'm talking about this has impacted the Fed's ability to have immediate effectiveness with changes in monetary policy.